If you're not sure where to start when looking for the next multi-bagger, there are a few key trends you should keep an eye out for. Firstly, we'd want to identify a growing return on capital employed, ROCE, and then alongside that, an ever-increasing base of capital employed. Basically, this means that a company has profitable initiatives that it can continue to reinvest in, which is a trade of a compounding machine. However, after investigating Ouhua Energy Holdings, SGX AJ2, we don't think its current trends fit the mold of a multi-bagger. For those who don't know, ROCE is a measure of a company's yearly pre-tax profit, its return, relative to the capital employed in the business. To calculate this metric for Ouhua Energy Holdings, this is the formula. Return on capital employed equals earnings before interest and tax, EBIT, divided by total assets, current liabilities, 0.12 equals CN 34 million yen divided by CN 894 million yen, CN 620 million yen, based on the trailing 12 months to June 2023. So, Ouhua Energy Holdings has an ROCE of 12%. By itself, that's a normal return on capital and it's in line with the industry's average returns of 12%. Check out our latest analysis for Ouhua Energy Holdings. While the past is not representative of the future, it can be helpful to know how a company has performed historically, which is why we have this chart above. If you'd like to look at how Ouhua Energy Holdings has performed in the past in other metrics, you can view this free graph of past earnings, revenue and cash flow. On the surface, the trend of ROCE at Ouhua Energy Holdings doesn't inspire confidence. To be more specific, ROCE has fallen from 24% over the last 5 years. Meanwhile, the business is utilizing more capital, but this hasn't moved the needle much in terms of sales in the past 12 months, so this could reflect longer-term investments. It may take some time before the company starts to see any change in earnings from these investments. On a separate but related note, it's important to know that Ouhua Energy Holdings has a current liabilities to total assets ratio of 69%, which we'd consider pretty high. This can bring about some risks because the company is basically operating with a rather large reliance on its suppliers or other sorts of short-term creditors. Ideally, we'd like to see this reduce, as that would mean fewer obligations bearing risks. To conclude, we've found that Ouhua Energy Holdings is reinvesting in the business, but returns have been falling. Although the market must be expecting these trends to improve because the stock has gained 46% over the last 5 years. However, unless these underlying trends turn more positive, we wouldn't get our hopes up too high. If you'd like to know more about Ouhua Energy Holdings, we've spotted 4 warning signs, and 2 of them shouldn't be ignored. If you want to search for solid companies with great earnings, check out this free list of companies with good balance sheets and impressive returns on equity.